I'm Lufungulo. I'm going to take you this topic, farm budgeting. First question is, what is a budget? What is a budget? Of course, we have a technical definition there, which is saying a budget is a financial or quantitative plan of operations of a firm for a forthcoming accounting period. So in short, a budget is simply a spending plan. Spending plan. That's what we're calling a budget. So we can call it a quantitative plan of operations, but it's actually just a spending plan. So this budget usually make it before an accounting period, and it's able to show us the income, expenditure, the working capital, capital expenditure, and departmental budgets. So a budget is a spending plan for a specified period of farming. When we are budgeting, we are actually establishing a budget is a practice of establishing budgets which identifies areas of responsibility for individual managers of regularly comparing the budgets with actual results. So the most important method of budgetary control involves the variance analysis, which is a comparison of actual results versus what was achieved in the period of accounting. So when we compare actual and results, the variance will give us a guideline for control measures. Because remember, the individual managers have to keep on controlling how the spending is happening. So for us to adjust, we need to compare the actual expenses with the planned expenses. Okay, so we have different kinds of methods for budget preparing. We have the traditional incremental budgeting system, that is number one. Number two, we have the zero-based budgeting system. Firstly, I'd like to talk about the traditional incremental budgeting system. So when we talk about the traditional incremental budgeting approach, it involves adding an allowance for inflation to the current year of actual figures to produce budget figures for the coming budget period. So that is the traditional method. It involves adding an allowance for inflation to the current year of the actual figures. Then we also have the incremental, that is a traditional incremental method. In the incremental approach, it is a reasonable method if current operations are as effective, efficient, and economical as they should be. However, it often tends to be an inefficient form of budgeting as it allows wasteful spending to be built into the budgets on an ongoing basis. So this arises due to the fact that the budget items are not scrutinized why they are actually required at that particular level. So that is the traditional incremental budgeting system. By contrast, we also have the zero-based budgeting, which starts from the premise that the budget for next year is zero. And here's the name, zero-based budgeting. This one has every cost being fully justified in order to be included in the budget, as if they are being included for the first time. So that's why it's called zero-based budgeting. It starts with the premise that next year is zero. So every cost has to be justified. Thus, all existing activities have to be justified and evaluated in exactly the same way as the new budget items. That is the zero-based budgeting. The advantage is that it puts a psychological pressure on staff to avoid wasteful spending and results in more efficient allocation of resources to the activities. So this is the zero-based budgeting. It helps you to become more efficient and to justify why you are spending the way you are spending. So as we are using these methods, we also set objectives or targets for our budgeting purposes. So these objectives are required. Number one, to set targets of operations and achievement for the organization. Just like an individual, you cannot operate without a plan. So even an organization also has to have um, a goal or a target such that when the targets are being met, you're able to measure. And then another point why we need to have objectives is to set a yardstick for measuring and assessing actual performance of the organization. It can be very difficult to measure how an organization is doing when we are not measuring the performance. So that is one reason why we make budgets. Another reason is to enhance control over actual performance by comparison of budgets with actual. So it boosts the performance when we make these budgets. Then another reason why we make objective is to provide a system of feedback of actual results to employees so as to motivate them by letting them know how they have performed. Then another reason why we budget is to communicate the plans and ideas to all the members of staff of what they are supposed to be doing and what is expected of them. Then another reason is to coordinate activities of different sections of the organization where departments are interdependent. We have what we're calling a flexible budget. A flexible budget is a budget that is designed to change as volumes of output or production change. A flexible budget is a budget that is designed to change as volumes of output or production change. A flexible budget is prepared so that it can reflect the actual level of production at the budgeted rates of activity. So that is a flexible budget. It will change as the volumes of outputs change. That's why it's called flexible budget. And this budget is prepared so that it can reflect actual level of production at the budgeted rates of activity. It allows the firm to compare the like with the like and the like with the like, unlike the fixed budget. So for example, a budget would be to produce and sell 2,000 tons of maize this season. But due to fluctuations in costs of inputs and hired labor, only 1,700 tons is produced and sold. So using a flexible budget system, the original budget of 2,000 tons will be flexed to the actual level of output, and the flexed budget is produced, which is used as a measure of performance of the firm. Why is a flexible budget necessary? Why is it necessary? Number one, actual volumes of output cannot be expected to exactly conform to the fixed budget. Actual volumes of output cannot be expected to exactly conform to the fixed budget. Comparing actual results, actual costs directly with the fixed line of budget is pointless and meaningless for actual control purpose. So for useful control information, it is necessary to compare the actual results at the actual level of activity achieved against the results that should have been expected at this level of activity. Thus, farm managers need to be informed about how good or bad the actual performance has been against this flexed budget for a meaningful variance to be uh, meaningful variance investigation to be instituted. Okay, so there we have an example of a budgeted and actual results. So in the first column, we have the sales and production. Then in the second column, we have the fixed budget. Then we have the actual output in the fourth column, right? So those are the units. So we can see, like for example, for sales, we have 1,000 units, which were budgeted for. Then actual units which were produced were 700 with a value of 14,200, whereas the 1,000 units had the value of 20,000. Then we have the variable costs of sales. The materials are at 8,000. The direct labor is at 4,000. The variable heads are at 2,000. So when we add up the 8,000, the 4,000, 2,000, we get a 14,000, which when we subtract from our value for sales, which is 20,000, we get a 6,000 as a gross profit. Then from the gross profit, we subtract the fixed cost of 5,000, and we get a profit at 1,000. That is according to the budget. And when we go to the actual, we have 700 units, which are worth 14,200. Direct materials, which we spent a 5,200. Then we have direct labor, where we spent 3,100, and overheads at 1,500. So when we total up our variable costs, it's coming to 9,800. So when we subtract 9,800 from the 14,200, we get a gross profit of 4,400. And then we need to subtract our fixed costs, which is a negative figure there. We're subtracting 5,400, and we get a loss of 1,000. Okay, so now we're continuing on the example of a budgeted and actual results. Why do we do that? To provide analysis for control purposes. It's necessary to distinguish between the changes in profit resulting from the volume of differences and those that are caused by excessive unit inputs or lower selling prices than expected. The flexible budget will look like one below. Okay, so we can see there is a flexible budget. Flexible budget. We have 1,000 units, which are worth 20,000 at 20 kwacha per unit. Then we have 700 units, which are worth 14,000. Yes. Then the actual was 14,200. So therefore, if we look at the budget, it was at 14,000, and then the actual was a 14,200. So there was a variance of a 200 there, right? A variance of 200. Then again, according to the flexible budget, we had direct materials, which were budgeted for the flexible budget, but budgeted at 5,600. Then the actual expense was at 5,200. So there was a variance of 400. So when you subtract 600, 56 minus 52, we get a 400. So there was that a variance from the flexible budget. And if we go on, we're able to see those differences. So there, like for example, the difference between 2,800 and 3,100 is 300. So that is another variance. So the direct labor was budgeted for 2,800, but it increased to 3,100. So it went up by 300. So that is what is there. Then when you come to the variable costs, they were budgeted in the flexible budget 1,400, but the actual was 1,500. So there was an increment of 400 there. So in short, we can see that sometimes the actual and the budgeted and the actual is usually a variance. So it can help us to plan for the next enterprise to be able to give us more profits. Yes, so we have various funds which are expected to be prepared at a firm. So number one, we have the revenue or income budget, which is composed of the following budgets: the sales budget for crops, animals, meat, eggs, and poultry sales, rental income, if you have any, and any other income, maybe donations, grants, etc. Another budget which can be prepared is called the expense budget, which is comprised of the following: the staff costs, which includes salaries, wages, benefit allowances, and leave pay. We also have the variable costs, which includes feed, inputs, chemicals, casual labor, and fuels from the farm, as well as operational costs, which are overheads, meeting costs, professional fees, finance costs. Then we also have the cash budget, which is a working capital budget, which is comprised of the following, which is in the following format: opening cash balance, expected receipts, maybe from sales, farm sales, rental income, interest, or investments, and any other. Then expected payments, and then expected payments for salaries, operations, meetings, finance costs, then the closing balance. So the master budget is a summary of the above budgets, and the finally prepared, and the budgeted income statement and balance sheet are also finally prepared. So as these budgets are being made, we also have policies which are followed, or regulations which are followed in the preparation of these particular budgets. So the following are some of the policies which can be enacted or can be followed in the preparation of a budget for a year. So number one policy is that the finance manager with the board of directors together with the staff shall identify the principal budget factor, which means this is anything that might limit, affect, or impede the organization from achieving its planned activities and should be taken into account when preparing these budgets. This will give direction the budget is likely to take, and in the case it would be the source of income. It is a source of income to finance operations. So yes, so as you're making the budget, you need to identify the principal or the main factor. That is anything which can actually affect or stop the organization from achieving its intended goals. So such that when you're making the budgets, this one is taken care of, and it is well taken care of, so that the organization is able to achieve its objectives. So number one, no, that's number one policy. The number two policy: the budget officer shall be the senior accountant who shall direct the budget proceedings as spelled out in these policies. We're continuing on the policies and procedures in budget preparation. So the budgets shall be prepared using a combination of both ways. That is the traditional incremental budgeting and the zero-based budgeting, depending on which type of expense is being evaluated. It shall be authorized by the finance manager or the board of directors. So in short, according to this policy, we're not being limited in terms of what method we shall use. We can use the zero-based budgeting, we can use the traditional incremental budgeting, we can use a combination of both. That's what this policy is saying. Then also budgets shall be referred to as annual operation plans, AOPs. So income budget shall be referred to as annual operating plan 1. And there shall be sub-components 1.1, 1.2, etc. Yeah, so that is according to this regulation. Then components, other components shall be like 2.1, 2.2. Then the expense budget shall be annual operation plan 3, right? And then the meetings with components, sub-components 3.1, 3.2. Then whilst the meetings budget shall be annual operating plan 4. The other one, staff costs, shall be annual operation plan 2. Yes. And then with sub-components 2.1, 2.2. And also, the cash budget shall be annual operating plan 5. So we follow these, our budgets. Again, another policy is that the revenue budget shall be prepared and finalized first before other budgets could be finalized, as this shall determine the level of other budgets. And this shall be finalized by 31st December. So you need to start with income, because you cannot operate any entity without income. So you start by dealing with the revenue budget first, then you should be able to make the other budgets, because they're actually derived from the revenue which you are going to receive. So the breakdown for each budget is according to the chart of accounts contained in this manual. All budget meetings for the following year's budget by the groups mentioned shall commence in September 1st and draft the budgets which are submitted for the approval to relevant committees by November 30 of the current year. Master budget shall be produced by December 31st by the budget officer after having reviewed and approved having been reviewed and approved by the finance manager or the board of directors. So that is one of the outputs for the budget officer. By December 31st, you should produce a master budget, which is subject to approval by the manager, finance manager, or the board of directors. Budgets shall be prepared using specific forms and shall be completed according to the instructions stated on these forms. Then budgetary control statements shall be prepared on a monthly basis and the variances analyzed and substantiated. This is for control monitoring. And the report on variance analysis shall be done on a quarterly basis for submission to the board. So when the budget, now we're talking about the procedure in farm budgeting, So when the budget preparation period draws near, that is 1st September, the budget officer, who is a senior accountant, shall inform staff and concerned staff to start budget work preparations. The finance manager, the board, together with the budget officer, should identify the principal budget factors as stated in the policy. The finance manager, the board, will direct each staff concerned which budget lines shall be subject to zero-based budgeting or incremental budgeting principles. Staff concerned will now collect the forms for preparation of their respective budgets from the budget office. On 30th of November, budget forms should reach the approving committees for approval. Within December, finalized and approved budgets from staff should be handed over to the budget officer, who shall now do a master budget. A master budget will be submitted to the board for approval on 31st December and shall be ready to use the following reporting period. Separation of duties in budget preparation. Members of the committees on budgets mentioned in policies shall not be involved in approving a budget where they were involved in preparing. This is to ensure there is transparency and there is accountability. So members on the budget committee shall not be involved in approving a budget which they are involved in preparing. The budget officer shall report to the finance manager or board of directors on all budget proceedings. No single person shall chair more than one budget committee meeting, and no single person shall be a member of more than two budget committees, such that there is separation of powers and such that the money is safeguarded. Yes, so there we have the forms which can be used in preparing the budgets. We have a sample of annual operation plan 1. And there with the income types, there's a crop sales, animal sales, meat sales, egg sales, other incomes. So this is an income budget, which is supposed to show the income type, the income code, the budget type, the quantity, the rate, as well as the total budget for this specific item. We have other forms. Here, there's a note which says rates for budget shall be supported by workings to show how each budget line was achieved or was arrived at, and this shall be attached to the annual operating budget 1. So we also have annual operation plan budget 2, which is a composite budget of the staff costs. So in these staff costs, we have the basic pay, the overtime, the allowances, and the rate. We have the number of employees on contractual basis, then the number of employees on hourly basis, and the number of employees. So everything is there, including the leave pay, the bonuses, and the total staff budget cost. So this is prepared. So the number of employees on leave days according to the conditions of service and the day's rate. Entitlement per employee as per conditions of service by the number of employees. So the rates for the budgets will be supported by working to show how each budget line total was arrived, which will be 2.1, 2.2, and this shall be attached as supporting to the above shown.